Is it the crypto one?
No.
Okay.
What's the crypto one?
No, I'm not gonna ruin it. I'm not gonna ruin it.
Okay, okay.
All right.
I had another one, but I'll come in with it. I'll come in hot with it after yours.
All right. Sounds good.
All right.
Welcome to the Money Huddle, a podcast that discusses financial topics for families, retirees, and small business owners. Hosted by Michael Baker and Ross Marinell. All opinions expressed by Michael and Ross or any podcast guests are solely their own opinions and may not reflect the opinions of Advisory Alpha. The podcast recording is for informational purposes only and should not be relied upon for investment decisions. Clients of Advisory Alpha may maintain positions in securities discussed on the program.
Welcome back to the Money Huddle. My name is Michael Baker, and I'm here with Ross Marinell. Ross, how you doing today, bud?
Michael, doing wonderful. This is our week in our family. This is it. We have so much stuff going on right now.
You gotta expound for me.
We've got the youngest child's birthday on the October 12th. We've got the oldest child's birthday on October 15th today. And it's a lot of fun happening in our household these days. So excited to be here, though. We got a little break before the madness, before this weekend. But, man, I'm excited to chat. We've got a lot of fun stuff to cover today.
I know, man. And can we start out with the simple fact that it cost me $71 to fill up my SUV yesterday?
Yes, we can.
I don't know, where I have been, if I've just not been paying attention. But last night, I needed gas, and I told my wife, I said, hey, before I go to, I got to get gas before I try to take the kids to school in the morning. So I'll, bebopped out. So not my normal routine where I'm getting gas like in the middle of the day, getting gas at night, nothing else, not me thinking what my next couple moves are. I'm going to, get gas, go home, go to bed. And I look at the meter, and I'm like, what is happening? $71? I don't drive. I mean, I feel bad for these people driving these huge SUVs, huge trucks that have gigantic fuel tanks. What does it cost to fill up a Ford F-150?
So think about this. I've got a couple of friends that run businesses where they have work trucks out. So I've got, we have a mutual friend who runs an HVAC business.
Oh, like Mike Gettings, Panther Heating and Cooling. Shout out to Mike.
Yeah, shout out to Mike, Panther Heating and Cooling. And you have 15 work trucks out there, crisscrossing, a couple counties, and how that increases, the cost for your bottom line when you've got multiply your experience times 15 or 20 plus. They're probably driving 5 times more than we are a day, maybe more. It adds up. It's this slow creep of inflation, and we're starting to see some. Obviously, this has it's been a story for a few months now, but it's starting to get real, right? Where we're starting to see gas prices at the pump. I saw an article from ABC. This came from ABC News. It said that the headline was "Winter heating bills set to jump as inflation hits home." Listen to this, Michael. They said with prices surging worldwide for heating oil, natural gas, and other fuels, the U.S. government said Wednesday it expects households to see their heating bills jump as much as 54% compared to last winter.
Wow, that doesn't sound like a good thing.
No, this is, and it could be worse in other countries. And so this is painful, because if you are retired and on a fixed income, or just find yourself in a lower income situation now, and you've got to pay 54% more for just heat, just to keep your house warm. And like you said, you're paying a pretty penny more to just drive yourself to and from, the places you got to go, get to work. This is where it starts to get people angry.
Yeah. Meanwhile, we won't even talk about the fact that at the very beginning, I'll leave that alone. I was getting ready to talk about the pipeline that we canceled, and all the regulations we put back on energy, but I will keep it moving. So inflation, we just had the most recent numbers come out. Inflation, continues to persist. Core CPI in September was 5.39%. I think the expectation was 5.3%. So not terribly off the expectation, but still higher than expected. And, I think we're starting, just about everybody is starting to see it in some way, shape, or form. And, we had talked about this amongst ourselves, but Jerome Powell still thinks this is transitory, but likely going into next year, 2023. What do you think? Are we going to be able to get this thing under control? We're going to be able, with the supply chain stuff that we're starting to see, they're telling us now, hey, buy Christmas presents in October, which of course, if you tell everyone, hey, there's going to be a shortage, buy it now, and then people panic buy, which only exacerbates the problem. What do you think, man? What are you seeing?
Well, so a couple of thoughts come to mind. One, so I'll throw two more articles at you that talk about it. There was a BBC article that said Kraft Heinz says people must get used to higher food prices. And part of it is stemming from just the raw materials, right? The cost of ingredients such as cereals and oils has pushed global food prices to a 10-year high. And so they're prepping us. Get used to higher food prices. It's coming. The supply chain issues are real, and they're starting to hit home. There was another article I found that was linked back to South Carolina. It said South Carolina schools face food supply chain disruptions. So schools across the Midlands are struggling to feed their students due to supply chain disruptions, and food service vacancies heighten this issue. So we have multiple problems, right? We're having job shortages at the shipping ports to get these boats unloaded. We're having a major truck driving shortage where we need truckers to move this product once it gets unloaded. And that's not a quick fix. These are not quick fix problems. I just don't see the idea that it's transitory. It sounds great when you're presenting to, your CNBC article or news audience. But the reality is this is a labor issue. We've got people that we need to fill these spots to be able to move this product. And you can't train somebody overnight to become a long haul trucker. Like, this is a problem that's probably been in the works for a while. And now, because we've had this forced stoppage last year, we've exploded it.
You bring up many interesting points. And what I keep thinking to myself is, this is a polarizing topic, but it needs to be discussed. And I think one of our problems here in, not just in the political realm, but just across many different things is like we're getting to a point where we don't want to have discourse and conversations that are uncomfortable anymore. And that's really not how problems get solved. But I'm thinking to myself, like, I understand, I've heard all of the discussions, I believe, on both sides of the debate for the vaccine. Should you do it? Should you not do it? And, the Biden administration is getting ready to put pen to paper and make their vaccine mandate come to life through the Department of Labor, through OSHA, through their regulatory agencies on businesses. And I'm thinking to myself, another data point that just came out was in August, 4.3 million people in August, 4.3 million people left their job. That people quitting their jobs. We have supply chain issues in a big way. The port issue is significant for a host of reasons. At what point do we stop and take a breath and say, you know what, maybe now's not the best time to be putting our boot on the necks of businesses? Let's fix these problems however we need to fix them, and then we can go back to implementing an agenda. What are your thoughts? Do you feel like they're going to just make it worse?
I came across a great phrase for this 4.3 million Americans quitting their jobs in August. 1 month. They called it the Great Resignation. And I think that's a very telling title, right? Because Now this is the labor component saying, I'm going to upgrade my job one way or another. And so maybe they're leaving for higher pay. Maybe they're leaving to join another company that's offering a bonus, because we know companies are increasing hourly wages. They're putting signing bonuses into packages for, entry level positions. There are people who are being told to go back to in-person work, and they're saying, no, I'm not going back. I like working from home. I'm going to keep working from home, and I'm going to quit and go find another job. And they're finding them. And so employers are already pushed into a situation that they may not have ever been in before, where they're not only struggling to find talent, they are having to increase their compensation and still struggling to find talent, because there are an abundance of opportunities. We know there are an abundance of job openings. And so the tide has turned a little bit on the employer-employee relationship. And it seems to me right now the employees have the ability to upgrade their work life, their income. And so part of it is you want people to be well compensated for the effort that they're, with their skills that they're bringing. But I think putting in even more pressure on employers to try and find people right now is a really dangerous spot. We are short labor.
No, I agree with that 100%. And I mean, I think if anything, one of the things that I personally have felt, people may disagree, but this is my opinion. I feel like that Americans in general one thing we do well, despite all of our disputes and differences, like, you give us a challenge, like, we'll rise to the challenge. I mean, if people just, put their differences aside, but sometimes it seems like we're getting to a point where it has to be more and more and more severe before people wake to that. But I'm just thinking to myself, like, I feel like if we were to come out and say, look, all right, here's where we're at. We need to figure out how to do this. I mean, I remember back in, the early stages of the pandemic, where, you had some of these cities like New York City where it was a hot spot. I mean, they were offering, significant pay bumps to bring in help from other states. And I'm just thinking to myself, I mean, I've heard different things, and I'm not the most educated on all of this. So in my mind, I'm simply saying, there's got to be a way to figure this out, that if people would put their differences aside, we could get to that. But that doesn't change the fact that inflation is still here. 4.3 million people left their jobs. I personally think that that's probably going to be a lot of that's people, like you said, Ross, upgrading and people starting their own businesses. A lot of people are just like, look, I can do what I'm doing, and I can basically make the same money, but work for myself and not have to deal with all these mandates and restrictions and the commute going back to the office. So I think that's going to happen. But right now, like you were saying, 10.44 million jobs are available according to the latest report. So 10.44 million. So we have jobs available. How that's going to shake out in the hiring, if you're an employer, that's going to be an interesting thing to watch.
So just to put a cap on that, just think one industry, we need 60,000 truck drivers. And I just looked at what the hourly wage those folks can make right now. This is not entry level pay. This is legitimate. You're in that $35 to $60 an hour range. That's a good income for a lot of people. So you got to think that labor will find its way there, because people are going to look around and go, hey, if I can do that job, and if I'm making $20 an hour now and I can go make 35 or 40, you would think that those spots get filled eventually. But how long does it take? How much do prices have to increase before we can reconcile that? It's anyone's guess right now. But, we start seeing stories about school systems struggling to provide food to kids. That's got my attention. And so we'll see how that shapes up. And, we're about ready to start. Third quarter earnings season has started. And so we will see how the retail businesses fare and how many of those were able to supply the product that their customers wanted. So we'll see what kind of commentary comes out from the CEOs of our retail businesses over the next few weeks.
I think, and I don't know if I'm super excited about this, but I see there being a huge shift to more online, people going online for goods and services. I mean, if you think about it, if you can wait 2 days, you can get just about anything now, provided that, shipping, and
Right.
all of that
It can
works
get
the way
to
it's
your
supposed
house.
to, so that's an issue to resolve. But as far as like going to the store, it's going to be really interesting to see, how these trends, unfold. That's 100% true. All right.
Well,
So
yeah, let's move on.
one thing, I guess, if you want to say there is a positive, it's more of an effect, a side effect, if you will, but it could be looked at as a positive for a lot of our people that are in retirement, on Social Security or claiming Social Security. There's going to be a large cost of living adjustment this year. 5.9% COLA was just announced to take effect for January of 2022. So a lot of people that are, living on a fixed income, or where Social Security is really a substantial part of your retirement income, you're going to see, a nice little bump in that benefit. And I think that's going to, hopefully help some people out.
That is a big jump. And what's historically been rolling out over the last couple of years has been under 2%. So I think the year before it was 1.9%, if I'm not mistaken. So it's a big jump for fixed income, Social Security recipients. The one thing, again, we would want to warn people is just take a look at your Part B premiums and see what you're paying, because the 2021 Part B premium is slotted to be $148.50. So if you are paying less than that now, Social Security can take a portion of that cost of living adjustment and pay it towards your Part B premium.
Yeah, give you a bump up. So just to round out this conversation, because we've been talking about, inflation, and I mean, that's the headline that keeps driving everything. But, we have to think about it too, not just from, our day-to-day lives, but like, how do we allocate assets? How do people invest? What are people doing? And there's some interesting things, and I shouldn't say that they surprise me, because they really don't, but every once in a while you just see something, you're like, gosh, like, would the data just be wrong, or the historical research just be wrong like once? But it seems to continually affirm itself. So I got this email that came in today from Y-Charts, and it's the fund flows report that they send out. And it's just showing, it's a breakdown of like market returns from various indexes, economic outlook, different, it's just a good data piece to look at. And so it shows like across the board, 1 month, 3 month, year to date, 1 year, year over year returns from various indexes. And so obviously I could go name them, but the vast majority of these equity indexes are extremely positive, double digits year to date, extreme double digits, I would say, year over year. We know that. We know the economic recovery, or the recovery in the market, isn't anything surprising. But here's what's interesting. Knowing all of that, so I could scroll down to inflows and fund flows. And Ross, what do you think over the last? We want to go over the last year. Let's just go year to date. Year to date, what do you think the most inflows? What fund or fund type have had the most money put into it year to date? What would you say?
So I would hope that it would have been equities.
We can hope all we want, brother, but try again.
Yeah. So I'm assuming something low risk, money markets, bonds.
Yeah. So money market funds. Right. Year to date, $286 billion. Actually, wow. See, these numbers are big enough. I can give you the decimal. $286.8 billion year to date have gone into money market funds. Do you want to know what the year to date return for that category is?
Less than 0.25%.
0.01%. All right. Now, let's continue. Do you know what? So this should be a gimme. This should be a gimme. So there's the most inflows. What do you think the most outflows year to date would be?
So probably large cap stocks.
100%. Year to date, the large cap growth has had $77.8 billion leave that type of allocation. Large cap blend, 62.84 billion. Year to date returns. Care to gamble on
17%.
year to date large cap for Y charts? This graphic shows year to date returns 13.17% for large cap growth. So this is a classic investor behavior, faux pas, if you will. I mean, people, they pull their money out, move it to cash. Cash is essentially negative yielding. If inflation is 5% and you're putting it into an asset class that's got a 0.01% year to date return, I mean, you're essentially like going backwards. You're not sitting still, you're
Right.
going backwards. Listen, I've had multiple conversations, and I know you have as well. Lots of people are concerned about what's going on with the market for various reasons. Concerns about the administration, concern about the Fed, concern about inflation, concerned about their job, right? Job security. I think that there are valid reasons to look at de-risking a portfolio and maybe moving to a different allocation versus like being tilted towards growth. But I struggle with trying to justify moving to cash when I know cash gets me zero. What are your thoughts?
Well, Barry Ritholtz said it the best. He said the best portfolio is the one that you can stay in during the best times and the worst times. Because trying to time these market movements and the big swings that people are predicting is very, very difficult. It is so hard to get right. It's hard to get right on the entry or exit, and it's hard to get right on the reverse, right? So if you think this is the time that the market's going to drop, you've got to be right on the exit. Well, you also have to be right on getting back in. And so you got to be right twice, and it's extremely difficult to do. And one of the things we suggest is finding that comfort zone where when the market's ripping higher, you're not looking at your portfolio and thinking, well, dang, how come I'm only up X percent of the market? And at the same time, when the market's dropping unexpectedly and quickly, you're not looking at your portfolio going, why am I falling so far? You've got to find that perfect balance of when you can be happy on both directions.
Isn't it also like a lot of behavior too? I'm thinking from the standpoint of, I mean, that what you just described, that ability to time the market, it's so alluring. It's like the siren song of investors, but it goes counter to everything. Because you think about it, like probably the best time to get out of the market, or I don't want to say get out of the market, but to get out of like your growth allocations is when the growth allocations are smashing, right? Because you're at the top. Like they've been trending upwards. Our recency bias is in full effect. Like, oh man, things are smashing. And then you sound like a buffoon if you're like, hey, now's the time for me to get out. Likewise, when everyone's starting to get out because, things are going bad and there's bad headlines, there's bad economic data, the market starts to move downward, and there's more selling pressure. Most people are like, hey, getting in right now doesn't feel good at all. Like this looks like it's really going to go south. Why would I put money to work now? And I think that's one of the things that we have to constantly be vigilant about as investors is, our feelings just betray us when it comes to what our money should be doing a lot of the times.
and a lot of times the headlines betray us too, because like you said, we rattled off, we spoke for 10 or 15 minutes about some pretty serious concerns we see about supply chain issues. And that's prevalent every day in the financial news media. And we start to think it should affect stocks immediately. In some cases, it doesn't. It may take longer. It may never even occur. So it's really hard to predict the future movement of stock market based on just the headlines that we're reading and seeing every day.
Well, I will cap it off with this, and this is a direct quote from Jamie Hopkins' book Rewirement. He wrote a chapter on retirement, many chapters on retirement risk, but Jamie, his Twitter handle I think is retirement risk. So there you go. his quote here: bonds used to provide two main benefits: a positive adjusted return, a positive inflation adjusted return, and diversification from market returns. But today, the return is all but gone, with real rates in 2021 for government bonds at essentially negative across the board. So, listen, this isn't us saying that bonds are awful. They have a place at the table, just like every other asset class does. But there's this idea that, especially right now with inflation peaking up, I hate to use there is no alternative, the Tina argument. But right now, I mean, unless you have like a really short term need for the cash, like hoarding cash right now is going backwards. And I know that there are a lot of people that are doing that because it helps them sleep at night. But we have to consider, if you are in your early 60s, late 50s, early 60s, even your 70s, retirement is a multi-decade long race. How long do we sit out of, potentially getting market returns? Because we think about average rate of return and we tend to think linearly, but if to get the average rate of return, that means you have to be in the market for the length of time needed to be in the market to get that return. So just be careful right now. I know inflation is scary. It's dominating the headlines, but like anything else, eventually I believe we'll get it sorted. I don't know how. I'm not smart enough to tell you how we're going to fix all these problems, but I do think that eventually they will sort themselves out because we tend to figure things out over time. Sometimes we have to learn a few lessons along the way, but inflation has given us some new things to consider. But thankfully for our people that are on Social Security, we're getting a nice COLA, 5.9% that'll start next year. And then, who knows? We might see a whole new revolution in thriftiness and people getting online and telling people, hacks of like how to cut costs and how to save effectively on their budget. There's all kinds of stuff that come out of the woodwork when we see adversity. But that's what I had today, man. What else you got?
No, I think that's great. We covered a lot of ground today. A couple of topics we could probably table for our next get together. Unless you have something else you want to jump in with?
No, I'm good. I think, the biggest thing that I would tell everyone is one of the things that's happening. I mean, we've seen in the last few weeks, we've seen some volatility in the market. I would expect volatility to continue. Investors can be tempted oftentimes to only think about volatility when they think about downside volatility, but let's not turn our nose up at the upside volatility. I mean, in the last 2 days, we've started earnings season so far. The earnings that we're seeing coming out, Bank of America announced great earnings. Goldman Sachs announced great earnings. JP Morgan, great earnings. We're starting to see, some of these, our biggest institutions, announce their earnings. And so far, it looks like it's off to a great start. If that continues, I mean, we can't just be deniers of what's happening. I mean, our businesses are finding ways to be profitable. And if you're an investor, that matters to you. So let's look on the positive and let's stop just focusing on downside volatility, because upside volatility is also part of the equation. So hang in there, folks.
There we go.
All right.
Awesome.
If you got any topics you want us to talk about, feel free to shoot us an email. Our email is themoneyhuddle@vcplanning.com. And as always, thank you for listening. Find us on iTunes, find us on Spotify, wherever you like to listen to your podcast. That's where we are. And we'll talk to you next time. Thanks.